Okay, so let's set the scene. It's 2005. The Federal Reserve is trying to cool things down, so they're hiking short-term interest rates aggressively. Now, every textbook, every model says long-term rates should follow. They should go up too. But they don't. They actually fall.
It was this huge mystery. I mean, the famous conundrum, right? Even Alan Greenspan admitted he was stumped. And most of Wall Street, they just sort of shrugged. They called it market noise.
But it wasn't noise. Looking back, it was a massive siren going off.
And that's really the core of our deep dive today into When Markets Collide by Mohamed El-Erian.
This book is so fascinating because of who he is. I mean, El-Erian isn't just an academic.
Not at all. He has this incredibly rare perspective. He went from the high-level policy world of the IMF.
Right, the 30,000-foot view.
And then jumped right into the trenches, managing billions at PIMCO and for Harvard's endowment.
So he bridges that gap between, abstract theory and the raw rough and tumble of a trading floor.
Exactly. And his whole argument is that the markets of yesterday are colliding with the markets of tomorrow. If you're using the old maps, you're going to get lost.
Which brings us to the first big idea, how we deal with those so-called glitches.
Yeah.
The noise.
Mm-hmm.
Most investors just assume, oh, it's a temporary blip, the market will snap back to normal.
But El-Erian says, wait a minute, what if the glitch is a signal of a deep structural change?
He tells this great story about a trader, Edward Cowan, at Salomon Smith Barney.
Oh, yeah.
While everyone else was buried deep in their complex math models, Cowan was using, street smarts.
He was literally reading tabloids to get a feel for the public mood. He sensed that when things got chaotic, it wasn't just a fluctuation, it was a realignment. The plumbing itself was breaking.
And El-Erian connects this directly to the market for lemons theory.
Akerloff's theory. It's so crucial.
Okay, so let's break that down. Imagine you're at a used car lot. If you have no way to tell a good car from a lemon, a total piece of junk, you don't just offer a lower price for every car. No, you walk away completely. You stop buying anything because the risk is too high.
That's it. And that is precisely what happened in 2007. The market didn't just get more expensive, it slammed shut. Banks looked at each other and couldn't tell who was holding toxic lemons.
So trust just vanished.
Completely. The market stopped functioning.
So that's the what. But what about the why? Why was there so much cheap money sloshing around to begin with? This gets back to that 2005 conundrum.
It does. El-Erian calls it the global handoff, or my favorite analogy, vendor financing.
Think of it like a car dealership.
The
The U.S. is the customer, buying a ton of cars.
And the dealership, think China or the oil exporters, is financing the loan for the car.
We bought their goods, sent them trillions of dollars, and they turned right around and lent that money back to us by buying U.S. Treasury bonds.
Which kept our interest rates artificially low for years. It was a stable disequilibrium. Poor countries were funding the consumption of rich countries.
So that's the noise from 2005. It was the sound of global economic power shifting under our feet.
And then eventually the dealership decides it doesn't just want to hold the loan, it wants to buy a piece of the car company.
The rise of the sovereign wealth funds.
This is the collision point. In the old days, if a developing country got into trouble, the IMF would ride to the rescue, right?
Sure.
But in 2008, it wasn't the IMF bailing out Western banks. It was sovereign wealth funds from Asia and the Middle East bailing out icons like Citigroup and Merrill Lynch.
The creditors became the owners, the saviors. So if the world works this way now, our old risk models are they're broken.
Totally broken. That old bell curve distribution that says disasters are super rare, it's dead. We live in a world of fat tails. These extreme catastrophic events happen way more often than the models predict.
So just diversifying, buying a bunch of different stocks, that's not enough.
It's not, because in a real collision, everything correlates. Everything crashes together. You need what he calls tail insurance.
But that's expensive, isn't it? You're basically holding cash or buying hedges that lose money most of the time.
It is expensive. You have to sacrifice some upside. You will underperform in the good years because you're paying for that protection. But the alternative is being completely wiped out when that fat tail event finally hits. You sacrifice a little profit today to make sure you survive tomorrow.
So the challenge to you, the listener, is to actually look at your own portfolio. Is it suffering from home bias, assuming the world still works like it did 20 years ago? You really have to ask yourself, are you investing for the world of yesterday, or are you properly insured for the collision that's coming?
There's so much more in the book, especially his whole concept of the elusive center and how binary all-or-nothing thinking just destroys returns. But we'll leave the mechanics of that for you to discover. Thanks for joining the deep dive.